Well, I have absolutely never filmed a video quite like this specific one before. Okay, so please bear with me today because I am going to show you a very real, incredibly complex financial situation that I have found myself completely trapped in, and I am actually going to ask for your direct help because I honestly do not possess a great answer for this problem. I woke up early this morning, stared at my brokerage balance, and thought to myself that I should just bring this straight to my amazing audience on this channel to see what you guys think. I even sat down last night and asked ChatGPT to give me a definitive answer to this exact scenario, and it fired back a couple of generic textbook answers, but I absolutely did not love any single one of those standard AI recommendations. And it got me wondering if any of you brilliant investors out there have anything innovative or outside the box to solve this specific problem. Look, let us be completely honest here from the very jump. This is definitely not a catastrophic life-altering disaster by any means, but it is a highly technical, frustrating puzzle that is causing me to think deeply every single day. So let us paint the entire picture and lay out the exact background setup so you can fully understand the madness. I officially retired from the corporate world at the very beginning of the year 2019, and if you cast your mind all the way back to that specific economic climate, the fixed income market and the sovereign bond market were paying, and I am being incredibly generous with my numbers here, significantly less than 1% on your cash. It was an absolutely painful, brutal time period to be a conservative investor looking for yield. Man, the banks were basically paying absolutely nothing on your savings. The returns were not keeping up with raging inflation by a long shot, and I just personally did not want to have a massive chunk of my hard-earned money permanently tied up in those garbage fixed instruments. I also possess, and I think this is an incredibly important personal detail that you need to know about my psychology, a very heavy, massive bias for equities and growth stocks. I was literally 100% aggressively invested in individual stocks and equity index funds throughout the entirety of my career, my entire working life, when steady income was consistently coming in the door, so I have that deep-seated equity mindset completely baked into my personality. Now, when I retired, I set up a classic three-bucket system. And my bucket one money was my short-term liquid money that I wanted to be completely safe from market volatility. And it is the exact cash pool that I actively spend out of to pay my daily bills. When I launched my retirement in 2019, I intentionally put 3 full years of net living expenses directly into this bucket one. Now, when I say net living expenses, I mean the exact amount of cash I need to pull from my portfolio after subtracting any other steady outside income streams I have coming in. So just for a clean hypothetical example, let us say I need a total of $50,000 a year to live my life, and I happen to have $20,000 coming in from deferred compensation corporate payouts. That means I only actually need to pull $30,000 a year from my investment portfolio. So using that specific math, I had $30,000 multiplied by 3 years, which equals $90,000 sitting completely safe inside this bucket one. Okay, now please understand those are definitely not my real-world personal numbers, but you get the exact structural logic of the framework. Right now in May of 2026, I keep that bucket one cash sitting beautifully in a Fidelity money market fund. But during my first few years of early retirement, I was frantically chasing a lot of different yield returns all over the place, putting in a massive amount of physical effort for very little real economic impact. It was a total mess. Man, I had cash locked up in rigid bank CDs. I was buying government, I-bonds, I was trading different individual corporate bonds, and it was honestly just a giant, unorganized operational disaster. But hey, that chaotic yield chasing journey is a topic for an entirely different video. So let us just focus on the core structure today. Just think of bucket one as 3 years of pure fixed income safety. Then right next to that, I created bucket two, which was designed to hold the cash that I might potentially need to pull from during years 45 and 6 of my retirement timeline. That was the exact window where I needed that capital to bridge the gap according to my master blueprint. And you have to remember that back then, I was absolutely not making a single dollar of income from this YouTube channel, so I was entirely reliant on my investments. So I took another 3 years worth of expenses and dumped them straight into balanced funds. Specifically think of something highly traditional like the Vanguard Wellington Fund, which is a classic 60-40 equity to bond allocation fund. And to diversify even further, I took that bucket two cash and put exactly half of it into that balanced fund and the other half into a high-quality dividend-paying stock fund. Now, you guys know me well. I absolutely hate to recommend specific individual funds on this channel. And that is the exact reason why I never recommend them to you guys. So that is why I generically talk about them as balanced and dividend buckets. Back in 2019, I looked at the market and said, man, I absolutely cannot stand getting less than 1%, 0.5%, or 0.4% in a regular bank account, so I am intentionally going to lean into these balanced equity funds just a little bit to juice my returns. And at the time, I felt incredibly comfortable with Bucket 1 and Bucket 2 acting as my pseudo fixed income security blanket. While a balanced 60-40 fund obviously isn't a guaranteed fixed income asset, it was leaning heavily enough towards safety for my lifestyle. And then, sorry for my terrible marker chart drawing on my whiteboard here, but my Bucket 3 was always 100% invested in pure aggressive equities for maximum long-term compounding growth. So that is the exact structural setup from 2019, and hopefully that makes complete sense to everyone watching. So now let us fast forward the tape all the way to Saturday, May 16th, 2026. To look at my current financial state inside Bucket 1, due to some major structural changes, I now have a massive 10 full years of living expenses, completely funded and sitting waiting for my assets. Again, I am fortunate to have some steady income coming in right now. I still have deferred compensation payouts hitting my account for another 4 years. I have a small corporate pension, and I have some awesome consistent YouTube income coming in from you guys watching these videos. But because of those income streams, I find myself sitting with 10 years of cash required from the portfolio. And let me clarify, I didn't just accidentally stumble into this position. This was done completely by strategic design, but that strategy is a topic for a whole separate video. So let us just say I intentionally chose a 10-year cash safety runway. Currently, about 50% of that massive 10-year runway is parked directly in a high-yield money market fund with Fidelity, specifically the SPAX fund. I guess I broke my own rule right there and advertised a specific fund name. But hey, it is what it is. I just recently looked up the official 3-year performance return for that specific fund, and it clocked in at an awesome 4.63%. That return is significantly higher than the garbage 1% yields I was getting back in 2019, and it is performing beautifully well above the baseline rate of inflation. So I really love utilizing that fund for my core cash positions. It gives me incredibly easy liquid access, meaning I can initiate a transfer and have that hard cash sitting in my local checking account within 48 business hours on the absolute worst case scenario. And honestly, most of the time, the cash lands safely within 24 hours. So it is an incredibly smooth, efficient process for me to get that money transferred over whenever bills are due. And the other 50% of that Bucket 1 safety runway is currently invested in a total bond market fund inside my traditional IRA. I just looked at the trailing 1-year return on that bond fund, and it delivered a very solid 5.44%. Now, please understand I haven't always been lazily sitting in this specific bond fund over the years. I was smart enough to completely avoid bond funds during the absolute bloodbath of the year 22. When rising interest rates caused traditional bond investors to take a massive 15% haircut to their principal. I managed to completely dodge that bullet and finally jumped back into this bond fund at the very beginning of the year 24. Remember, like I just said, 22 was real ugly for fixed income, so I timed my entry perfectly. Looking back at the 1-year trailing return of 5.44%, I have been intensely satisfied with how my Bucket 1 money has been performing. I keep my process incredibly simple. Man, I just have 2 core funds holding the fort. I guess you could technically count 3 funds if you include my everyday local checking account that I physically spend out of, but I only keep about 1 month worth of lifestyle cash in there, and I am constantly moving money over from my core Fidelity money market fund to keep it topped off. Now let us talk about Bucket 2, because this is where the massive unprecedented opportunity and the massive problem both live. Just for a clean mathematical example for this video, let us say I currently have a full $400,000 sitting inside this Bucket 2 portfolio, and within that $400,000 total balance, I happen to have a fixed $200,000 cost basis. Okay, that detail is incredibly critical for you to understand the tax nightmare I am facing. Remember, 50% of this money is sitting in a balanced 60-40 fund, and 50% is in a dividend-paying stock fund. Now, what is absolutely incredible about this experiment is that the compounded annual growth rate since I first bought these funds back in 2019 has been a staggering 11% and 9% respectively. So if I stand back right now and objectively look at Bucket 2, which was this wild little experiment I started when I hated fixed rates, the strategy worked absolutely great. It performed incredibly well. In fact, it worked way too damn good. Man, I originally created that bucket 2 buffer because I completely despised the microscopic returns inside bucket 1. And that equity, laning bet paid off very nicely for my net worth. I have absolutely zero regrets about making that move. But the massive problem is that its incredible success has now created a giant structural dilemma in May of 2026. Meanwhile, my bucket 3 portfolio is doing completely fantastic. It is 100% invested in pure equities for the long haul. I currently have 90% of that growth money locked up in a traditional IRA, and the remaining 10% is sitting inside a Roth IRA. My long-term goal has been to continually increase the percentage of wealth inside that tax-free Roth IRA, but the underlying stock investments inside the traditional IRA just keep going on an absolute tear here. The market is ripping so fast that the traditional IRA keeps growing exponentially faster than I can physically convert or put money into the Roth. Sorry. So here is the exact focal point of the problem. Like I said, it all comes back to bucket 2. Right now, I am automatically reinvesting all of the dividends and all of the interest generated by those funds back into the positions. So I am not actually using that cash to live on at all, because things like my steady YouTube channel money are causing me to not need any extra cash flow from my investments. My original retirement blueprint back in 2017 was to eventually take some of those quarterly dividends and interest payments and let them naturally flow directly into bucket 1 to act as a nice little organic cash refill. But because my YouTube income is completely offsetting my lifestyle expenses, I do not need that cash flow, which creates a massive ongoing tax drag on my taxable brokerage account. So I am stuck paying heavy annual taxes whenever the fund managers happen to sell assets inside of the fund. Plus, I am getting slapped with taxes on the continuous dividends and interest distributions every single year. And the ultimate truth is that if I were to look at my portfolio objectively today, bucket 2 really doesn't serve a clear purpose in my financial plan anymore. That is the exact root of the problem. Okay, think about it logically. My bucket 1 completely provides me with 10 full years of rock, solid fixed income safety, and my bucket 3 holds all of my pure equities for maximum long-term compounding growth. Those are the only two functional things that I actually feel that I need in my retirement plan right now. But I am sitting here holding this massive heavy holdover of bucket 2 from a bygone era when fixed assets were paying absolutely nothing to investors. Look, I know this is an incredibly good problem to have, and I am absolutely not complaining about being too wealthy or making too much money. Man, I am just looking at this situation through the lens of an optimizer, asking if there is a smarter strategic action I should be actively taking right now. In May of 2026, what are your innovative ideas on the specific actions I should be taking with this capital? And you have to keep in mind that if I simply click sell on these funds tomorrow and buy clean equity index funds like VU, I will instantly trigger a massive $200,000 capital gains tax bill, and I absolutely do not want to hand that massive chunk of cash over to the government if I can avoid it. So what are your real thoughts on this? Let us break down the exact options I have laid out on the table. Okay, these are the 4 distinct paths that I have identified given the current macro state, and honestly none of them are perfect, and none of them are inherently bad either. Option number 1 is to immediately stop automatically reinvesting the dividends and interest inside those bucket 2 funds, and instead, take that fresh distribution cash and manually buy something like the SP 500 VO index fund directly inside my taxable brokerage account. That is a very simple, practical move you could execute tomorrow. It kind of begins to tackle the problem because it takes that future tax drag down just a little bit over time by shifting new capital into a highly tax-efficient index fund. But yeah, it is definitely not going to do anything dramatic or fast. It is essentially heading in the right direction at a pretty slow, agonizing pace. Option number 2 is to completely keep the funds exactly where they are, and instead intentionally create a donor-advised fund for aggressive charitable giving both right now and as a long-term family legacy. My wife and I already love to give away money to great causes right now, and we already have major plans to leave behind a meaningful legacy when we pass away. And setting up a donor-advised fund allows us to completely avoid the $200,000 capital gains tax problem altogether. Okay, yes, I fully understand that the money inside a charitable donor-advised fund may not grow quite as aggressively over the next 30 years as it would if it were purely invested in a tax-efficient equity index fund, like VU. But hey, if you are terrified of lighting $200,000 on fire in capital gains taxes, this is a highly viable option, and it sits directly in the line of sight of what we are already trying to achieve as a family. This is exactly what our ultimate plan is all about. Option number 3 is to just bite the bullet, sell the entirety of Bucket 2 tomorrow, pay the massive capital gains tax. And if there is any extra net investment income tax that comes screaming out of that transaction, fine, so be it. Just do it, pay the government, move on with your life, and get this annoying structural problem completely behind you once and for all. And this specific path could actually have several different structural components or sub-options to it. Let us say, for instance, you could do the entire liquidation in one single tax year, or you could strategically spread the sales out over 2 years, or even map it out over a 5-year window to completely eliminate the net investment income tax bracket and just pay the baseline long-term capital gains rate. That staggered approach may very well be the absolute right thing to do for my total wealth profile. And finally, option number 4 is to just shut up and be happy. Man, just be happy with the cards I am holding, smile, and enjoy life. The historical returns on these funds are pretty damn nice. You know, probably when you combine the performance together, I am locking in right around a solid 10% return. Since I first launched Bucket 2 back in 2019, I have maintained a 10% compounded annual growth rate on that money. That is absolutely nothing to feel bad or stressed about in retirement. That is actually an incredibly very good outcome for any investor. So those are the 4 realistic options I have currently written down on my notepad. I would absolutely love to hear down in the comments section below what you would personally